Hi, on behalf of IAIP, it's my pleasure to welcome Mr. Chris Franzek, who is an MD at Duff and Phelps, New York office. He specifically looks at portfolio valuation in the company. And we also have with us Mr. Gupta, who's an MD, who looks at the India business of Duff and Phelps. We obviously, as CFA charter holders and IAIP members, are very much interested in investments. I think most of our focus is on the primary and secondary market investments, where we actually look at shares and the valuation of shares. There's also a big arena where you look at venture capital funds and private equity funds who probably invest in a startup and before the primary market is accessible to them. And we always wonder that what happens in that arena. How do they value a company? How do they invest in a company? How many shares they get? And once they invest in the company, how do they track the company? Because for a listed market company, we have research reports, analysts, one company being covered by 80 people and you get all the figures. But in the VC PE space, it's unlisted, a lot of work is supposed to be done. And then they have their own ways of valuing those companies. This is the front, or what you see per se. The people who invest in VCs and private equity funds, right, they also need to have returns worth their money. And they also need to check whether the VC funds and the private equity funds are doing the right thing, and they should also be able to track what the VC funds and PE funds are doing. And if I'm not wrong, that is where Duff and Phelps comes in, and they help the end investors look at parameters of their VC and PE investments, and they help them to periodically review what they're doing and to periodically value the investments in this PE and VC funds. And in turn, it also helps when they also look at how do you exactly value your investments in a startup or a pre-listed scenario. So with that, I'd like to welcome Chris on the stage. The way this session will work is that he'll speak on the way they do their work and the valuations, which will be followed by a Q&A session. Chris has said that he'll be very happy to take questions while he's speaking, but I'll suggest that let him complete his thesis, and post that once you open the Q&A, you can ask as many questions as you want. Post the event, we'll break for snacks, and that is when you will get a chance to network with Chris and his team. So with this, I'd like to welcome Chris on the stage. Please.
So thank you all for coming out. I really appreciate it. I know this was all organized at a relatively late date, so thank you. We appreciate it. As mentioned, I'm more than happy to answer any questions. I'm not here every day. This is my first time to India. I'm loving it so far. I'm definitely going to come back. But please feel free to ask questions along the way. It's what you want to understand and learn. So take advantage of while I'm here. So, as mentioned, I run Duff and Phelps' portfolio valuation business. We work with about 350 funds, typically on a quarterly basis, helping them value all of their illiquid securities. So, as mentioned, it's not the things that are traded, but investments ranging from private equity to real estate to middle market leverage loans, sports teams, music libraries, film libraries, you name it, whatever fund is willing to invest in, we help them value it. So we have a pretty broad breadth of experience. Specific to you guys, probably the most relevant would probably be private equity or loans in your space. Just show of hands, how many people are more interested in equity? And then debt? And a couple others that are other. Okay, so I'll touch on both to help out. So, whether we're looking at equity or debt, for both of them, we start off with what's the value of the enterprise. That to ultimately get to equity, we have to understand what the enterprise value is, go down the capital structure to get to the equity value. For debt, we want to make sure we understand the enterprise value to see is the debt covered before we ultimately look at a yield analysis. As mentioned, there's no analyst reports out there for private companies. That you are the analyst, so you're trained. That's what you studied. That's what you work on every day. So it's your job to create the research, be it starting at the top level of economic research, going down to the industry, and then looking at the company, how it fits in its industry, how it's operating, and ultimately how that translates into value. When we look at the value of a company for our clients, we typically will look at the three classic approaches to valuation. We'll look at a cost approach. In the world of venture capital, often it's called last round of financing. We'll also look at a discounted cash flow analysis or some type of income approach. And lastly, some type of market approach, which is either considering publicly traded comparable companies or transactions. And transactions may be for transactions of similar companies in the same industry, or actual transactions in the company stock, which also may be considered cost approach or last round of financing. The way that we think about it is that really, even if the company has no earnings or has no revenue, the fact is that there are three approaches to consider, and we may consider each of those approaches, and there may be multiple scenarios of each approach. So you may have a best case and a worst case DCF that you're incorporating. We will consider each approach at every evaluation date going forward, and we'll encourage our clients to do so as well. Implicitly, what you may end up seeing is last round of financing, for an early stage venture company. The reality is, though, that while you just see that as what the support is for the ultimate valuation that the fund is putting into its financial statements, the reality is that they put 100% weight on the last round of financing and 0% on the discounted cash flow or income approach and 0% on the market approach. And I think it's important to think about that because over time, a company will evolve. Its ability to earn and generate income will change, and or the market comparable companies or transactions that may provide indications of value for the company will also change. That there may not have been any, comps. About a year and a half ago, we started looking at an online gaming company, online casino company for one of our clients that made an investment in that space. And when they made the investment, it was clearly last round of financing because that's all there was. About 5 months later, and there was no, they didn't have cash flows, they had a forecast, but they really hadn't demonstrated an ability to meet anything yet because it was a brand new company. There were no public comparable companies out there. But 5-6 months later, they had some level of cash flows or revenue. They also, one of Caesars Acquisition Corp went public in the US. And so all of a sudden we went from not having a comparable company out there that had some indication of market value to it to having one. So we went from 100% cost approach to now considering the value of a very good market comparable company for that company at the new measurement date. And so all of a sudden we went from 100% and 0-0 to some different weighting over time. And as now that they're, a year and a half down the road, their cash flows are becoming better or more predictable. There's still aspects of it that are not. In the US, online gaming is highly dependent on regulatory approvals, and right now only New Jersey has approved it. So they're waiting for California, New Jersey, Pennsylvania, New York. When those states approve it, that will change the cash flows dramatically. So their New Jersey revenue has become predictable. But the fact of the matter is that's a very small percent of the market, so we're still not putting a lot of weight on DCF. But they do have multiple scenarios. So to give you kind of an example of how we think about things, over time those evolve. And one needs to think about it. Right now we're looking at, I think another good example would be, say, Alibaba. So last year we looked at it for probably a dozen different funds. We didn't have great cash flow forecasts from the company because we were looking at it for an investor in the company, and they didn't have the rights to board presentations and whatnot. So we were largely looking at transactions, and the transactions we were looking at were between investors and Jack Ma himself to solve his own liquidity issues. We were looking at transactions between Alibaba and investors, as well as some investors saying, okay, we've ridden this long enough, we've made enough money, we're going to sell our piece to somebody else and let them take a ride. And so looking at all those different transactions, some people knew more than other people, but because we sat in the spot where we saw so much, we were able to put together a pretty neat mosaic of what was happening in the market. And by the time it went public, we had a range of values for the company that was pretty much spot on, overlapping with the going public range. It went up after, but at least, you know, on day one, we pretty much hit it spot on. And it felt pretty good. Now, we're not always going to be that right. But again, I think from our perspective, the way that we view valuation is that anytime we come up with a number, just pretty much by definition, it's wrong. You know, to the penny, it's hard to be that right. We tend to think more in ranges of value, that we think within a reasonable range or you know, variance, that we can be have a much higher probability of being right at any one point in time.